Hello, everybody. So I'm making a very quick video today because the Fed is getting worried again about regional banks, and rightfully so, because it seems like the Fed is still going to raise interest rates tomorrow, and we may have more bank failures happen. That is what I fear. That is what I don't want. That is what I think nobody wants. And this is a picture of the S&P 500 on Finviz, right? That was taken about a year ago before this whole banking crisis happened. And you can see you have the second and the third largest bank failure in history that has happened within a state of 50 days. Over the past 50 days, we've had the second and third largest bank failures in history, and this is the S&P 500, right? So if you owned an index, FRC that I've highlighted here, First Republic, and SVB that I've highlighted here, they've disappeared. They've entirely disappeared. They've gone to zero, and I believe this is a tragedy because owning the S&P 500 is seen as almost irrefutable science by all investment advisors and people who give all sorts of advice, which is what I don't do. I don't give any advice, but it's a common thing, right? Jack Bogle's entire career is based on the index fund. So many books tell you, the S&P 500 is the way to go, except banking is not doing well right now. And so in this channel, I only focus on growth stocks and just talk about growth stocks. Just if you compare the S&P 500 to the NASDAQ, and that's the NASDAQ 100, for example, the triple Q without financials, it's been doing so much better over the past 10 plus years. And why is that? Because it removes those companies that do not grow revenue as fast as the money supply. But let me just go on and show you what has happened with the banks. And we've all followed what has happened with the bank, but people forget, like First Republic Bank was a $27 billion market cap. I mean, that's essentially the size of, I think, Target, maybe Target as it was trading 2 years ago, the size of a Target. But it's a big company, 27 billion market cap, and it's zero. It's zero now, minus 100%. It's zero, and that's the same story for Silicon Valley Bank. Silicon Valley Bank actually traded even higher than First Republic Bank. And despite this is what's happening right now. PacWest, Bancorp, minus 31%, minus 11%, minus 20%. It depends on which time of the day you look at. I mean, there's really jitters, but if you add all of these banks up, you get another circle like this. And granted, not all of them are in the S&P 500, but keep in mind, if you own a total stock index fund or a total world stock index fund, these companies are going to be in there, and they can just get wiped out because of the Fed and because of this increase in interest rate. Because one thing is as certain as it can be, in my view, is that as the Fed keeps raising interest rates, more of these things are going to happen. And the market is very fearful that tomorrow the Fed will raise again. Now, the Fed watch tool went a little bit down compared to 5 days ago, where it was in the high 80%. Now it's 78%. But it's still very likely that we get 25 basis points tomorrow, according to the Fed watch tool, as we see more and more banks getting in trouble. And to me, this is so obvious, but this is so dangerous to do, because the more hikes you have, the more there's rate hikes, the more people with checking accounts, savings accounts, they have an incentive to get their money out and go buy treasuries. Right? Or when they hear things like, oh, there will be no help, no bailout, or the FDIC is only $250K, no more, what they'll do is they'll move to the big banks. So the world is filled with endless incentives to get money out of banks and put it elsewhere. They might even put it in stocks. They might put it in Bitcoin, and it's a very, very real, very serious patterns of conversations where people are getting money out of regional banks and buying Bitcoin. That's a thing. The counterparty risk is just so high that people don't want to take the risk, and it is obvious that you wouldn't want to take the risk if you're banking at a small bank. And the more the Fed keeps raising rate, the greater that incentive becomes. And in my view, I mean, I've said this multiple times. And by the way, this is not about wanting cheap growth stocks. I'm very happy to buy growth stocks at the level that they are. Lowering interest rates will lift all boats, right? Not just growth stocks, but it might be such a fact that actually dropping interest rates will actually help the banks much more than it will help growth stocks much more, because growth stocks are taken down by high interest rates, but banks can go bankrupt when you have interest rates this high. Anyways, I'm just a little shocked by what is happening right now. I really hope we don't get a rate hike tomorrow. I really hope we don't. And I really hope the commentary after that rate hike, right, which started at 2 p.m. Eastern time, I hope the commentary is appropriate. But let's just briefly, I haven't had time to address it on the channel, but the First Republic acquisition. So the FDIC estimates cost, but we know these costs rise. We know this is going to cost more. I mean, I think it's going to cost more. They estimate the cost is going to be $13 billion. I mean, do these numbers even make sense to us anymore? Do we even realize the cost of this? This is what's going to increase the cost of banking at all banks, by the way, because fees are going to increase on FDIC. But then they provided to JP Morgan for the acquisition, they provided $50 billion in financing. And the question that I always ask is, all of these new programs that you put in place with new money being issued to pay, when are they getting paid off? Like, there is no, you're creating inflation differently, but there is no way to get out of more money stock out there. This is adding to the money stock. Right? Either way, whether you add to the money stock by reducing interest rates, or whether you add to the money stock by keeping interest rates high, but then helping out the banks on the back end, the result is just the same, which is the size of the money stock increases, the size of the debt increases, and we never pay it off, which is why I show in my prior videos things like a Sears home in the 1900s. A nice, decent Victorian-style Sears home was $800, and now it's $400,000. That's just the way this works. And how many more rescues will be needed if the Fed keeps raising rates? So let me just have some fun here. Show you that chart, right? These are the two that went bankrupt. So what's at risk, right? What is at risk here? Is it let me forward. Bring to front. Is it the regional banks? Is it all of this that is at risk? Right? Is it bigger than that? Do we have regional banks that are at risk? Maybe half of them. National banks, I meant. Like how big is the risk to the S&P 500, right? Is it something of this size because it spreads to the insurance world, which also has issues? Like how big is it? So anyways, I'm very happy to own tech stocks because tech stocks do not have that threat nearly as much. Tech stocks are going to have lower revenues and it's going to weigh down on them. But it's not an existential risk. Like these rates going up is an existential risk to the banks. So I sleep well at night, and I sleep well at night because I only own growth stocks with no debt or next to no debt, or when they have debt, I try to subtract the debt in my valuation. The reason why growth stocks, I believe, have become a necessity today is because if you, as a company, if you're not growing as fast as the increase of the money stock, which, by the way, M2 is an inaccurate measure of money stock. We don't know how many dollars are out there in M2. It's an inaccurate measure. And then you need to add the euro dollar. Everybody forgets about the euro dollar. We need to add the euro dollar to that. We don't know how many euro dollars are out there, dollars that are held outside of U.S. financial institutions. We can see the money stock, the US dollar money stock, the denominator. That's why this channel is called Beat the Denominator. The denominator keeps growing. So the only way for a stock to keep up is for the revenues that come in each year be at least equivalent to how much more dollars are flowing into the economy, which is why on this channel, I make it a point to have companies that have at least 30% revenue growth, because I want to earn 15% real returns. So not only the first 15% of growth have to be there to catch up with monetary inflation. The first 15% of growth in revenue of any company is just catching up with monetary inflation. And then what's on top of 15% is actual growth. That's the way I look at this, right? And that's why I've mostly focused on revenue growth, stocks, high revenue growth. And by the way, a lot of these companies have no debt. And whenever I see this happen, I sleep well at night because, as you may know, if you follow the channel for a while, I don't own bonds, I own Bitcoin. Bitcoin replaces bonds in my portfolio, right? For my age, I should have 35 to 40% of bonds. I don't have that. I have Bitcoin because I believe Bitcoin doesn't have the counterparty risk that bonds have. Right, it's not as risky. I mean, and anyways, it's not sorry on Bitcoin. I just wanted to make this little rant. I am sorry, it's a little bit of a different video on the channel, but we are seeing this unfold, and the rate hikes keep going up, and it also makes me sad, quite frankly, because keep in mind, each of these banks is sometimes 10,000 plus employees who have worked their whole lives, who have had their entire careers for these banks, and they're just disappearing. And anyways, it's instead of letting the market of innovation play and having, say, who knows, like First Republic may be innovative. There may be an innovation in there that could have helped them. No, it's the macro that ends up deciding these things instead of the traditional competition from bank to bank, from technology company to bank. Like, I want to see real competition define who wins in the marketplace and not the macro. But it is the macro right now who's weighing on every single investment thesis, every single stock investment, you name it, has been impacted by macro, such that we have valuations that are entirely lost, that do not make much sense anymore, or at least we do not have the frame of analysis to look at them. So anyways, thank you so much for watching. I hope there is no rate hike tomorrow. I really hope there's none of that. Thank you so much for watching. Have a great day. Oh, by the way, this was not investment advice. This is just entertainment. Please like, please subscribe.